So, colleagues, before we begin, let me invite us all to pause for a minute of silence in honor of the two cabinet ministers and 6 other distinguished Ghanaians who tragically lost their lives in the recent helicopter crash. Their service to our nation and the legacies they leave behind deserves our deepest respect. May I therefore ask us to observe a minute of silence as we remember them. Okay. May their souls rest in peace. So it is always a pleasure to engage with you, captains of industry. You are key partners in safeguarding and shaping the future of Ghana's financial system. As I always say, your leadership, your adaptability, and your commitment have been instrumental in maintaining sector stability and fostering the trust of the public we collectively serve. So this post-MPC engagement is more than a routine touch point. It is a strategic platform for us to exchange perspectives, to align on policy directions, and to chart the next phase of our sector's evolution. It is here that we translate monetary policy signals into actionable banking strategies, ensuring that the macroeconomic gains we secure at the policy table are reinforced and multiplied through your balance sheets, your lending decisions, and your innovation agendas. So, for a short recap of the macroeconomic condition and the MPC deliberations, the July MPC deliberations took place against a complex and evolving global backdrop. Remember, the IMF projects global growth to slow to 3% in 2025 from 3.3% in 2024, reflecting persistent trade tensions, moderated disinflation, and tighter financial conditions. For emerging markets like ours, this environment demands vigilance, it demands agility, and it demands a clear-eyed strategy to mitigate external shocks while leveraging domestic strengths. So back home on the domestic front, the story is one of resilience and momentum. On economic growth, our economy expanded by 5.3% in Q1 this year. Non-oil GDP was even higher at 6.8%, which was powered by robust agricultural outputs and a buoyant services sector, the sector you operate in. Activity levels have also been strong. Our composite index of economic activity posted a strong 4.4% year-on-year growth in May, signaling sustained dynamism in consumption, in trade, in construction, and in tourism. On sentiments, the business and consumer confidence has strengthened, buoyed by easing inflationary pressures and a stable cedi. These sentiments are critical. They shape investment decisions, they shape credit demand, and they also shape the willingness of households and firms to take calculated risks for growth. On inflation, it has maintained its decisive downward trajectory, falling further to 12.1% in August 2025 from 13.7% in June, marking the lowest level in nearly 4 years. Inflation expectations remain firmly anchored across households, businesses, and the financial sector. This is more than a statistical achievement. It reflects the tangible restoration of purchasing power for households, greater certainty for business planning and investment, and a more favorable risk environment for banks to expand credit prudently. Fiscal consolidation has also been noteworthy. The deficit stood at 0.7% of GDP in the first half, which was well below the target of 1.8%. This discipline, coupled with reduced borrowing, has contributed to lowering the public debt to GDP ratio and enhancing fiscal credibility. On the external front, Ghana's buffers are stronger than they have been in years. The gross international reserves reached 11.1 billion, which is equivalent to 4.8 months of imports cover by the end of the first half. Accordingly, the CD has appreciated over 40% against the US dollar, talking about year-to-date terms, a performance unmatched in recent memory. This stability is not just a macro headline. It underpins predictable pricing, investment planning, and the attractiveness of Ghana as a financial hub. Now, considering these developments, the Monetary Policy Committee lowered the policy rate by 300 basis points to 25%. This signals a gradual shift from a purely defensive monetary stance and toward one that cautiously supports economic growth on condition that the disinflation path remains on track. Colleagues, there is scope for further easing going forward if macroeconomic conditions continue to improve, and in particular, if August inflation, September inflation continues to settle within the target band. For the banking sector, this opens a window for you to re-examine your lending strategies. You have to broaden your access to credit, and you have to support private sector-led growth while still managing your risks prudently. On the banking sector, colleagues, the sector remains a cornerstone of Ghana's economic stability. The latest supervisory data confirms that the sector is well capitalized, it is liquid, and it is profitable. We have seen a steady decline in non-performing loan ratios, reflecting both the improving macroeconomic environment and the enhanced credit underwriting standards you have implemented in recent years. The recapitalization journey, driven by both retained earnings and new capital injections, has reinforced balance sheet resilience. This positions the sector to absorb shocks and seize new growth opportunities. But with this resilience comes responsibility. Our monetary policy stance has begun to shift towards supporting growth, and it is critical that banks align by stimulating credit to the private sector, particularly to productive areas of the economy. This must be done with prudent risk management, ensuring that credit expansion does not compromise the quality of your loan books. The challenge is to grow lending while preserving the hard-earned stability that now defines our financial system. The Bank of Ghana will soon implement a consolidated set of measures that are designed to strengthen resilience, enhance transparency, and align our banking system with the highest international standards. This agenda addresses both the forward-looking reforms that will future-proof the sector and the immediate corrective actions needed to close existing compliance gaps. We will begin with credit and risk governance. In this direction, all banks will be required to identify and take firm action against deliberate defaulters to ensure that credit obligations are honored. A new credit risk management directive that is aligned with Basel principles will set minimum standards for underwriting, monitoring, and provisioning. Alongside this, we will introduce a bank assurance directive, which is meant to strengthen governance in bank assurance arrangements. We'll also introduce a large exposures directive that is meant to limit concentration risk, and we will introduce new guidelines on credit concentration to encourage greater diversification across loan portfolios. On liquidity and capital resilience, there's a forthcoming liquidity risk management directive, which will mandate that banks hold sufficient high-quality liquid assets, enough to cover 30 days stress scenarios. This measure will also close loopholes that have allowed the artificial reduction of reserve requirements, including the misclassification of deposits as borrowings, and will clarify the treatment of e-money float accounts. We will also introduce a framework for managing interest rate risk in the banking book, strengthen capital planning through the internal capital adequacy assessment process, and embed more robust stress testing to ensure early detection of vulnerabilities. In the area of market conduct and foreign exchange compliance, colleagues, we are tightening enforcement of the Foreign Exchange Act and the guidelines for inward remittance services. This means there will be no use of unapproved channels for remittance terminations. There will be no FX swaps within remittance operations, and there will be no remittance terminations without Bank of Ghana approval. And let me emphasize that. No remittance terminations without Bank of Ghana approval, and no application of unprescribed FX rates. And effective immediately, all banks and payment service providers must submit weekly inward remittance reports that detail transactions and FX credit to nostro accounts. Failure to do so will attract sanctions under the Payment Systems and Services Act, as well as the Banks and Specialized Deposit-Taking Institutions Act. At the same time, we will engage the Ghana Association of Banks in a structured discussion on proposals, some of which they have shared with us, relating to NOP support, relating to FX forward auctions, remittance coordination, and market liquidity, and all these with the aim of agreeing on practical, market-friendly solutions. Finally, we'll be undertaking a strategic business model thematic review, and this will involve a forward-looking assessment of the sustainability of bank strategies and will require the full engagement of boards of banks as well as senior management. Together, colleagues, these measures form a single, coherent regulatory framework that not only enforces compliance with existing rules, but also positions Ghana's banking sector to withstand future shocks, compete globally, and play a stronger role in supporting sustainable economic growth. Colleagues, the road ahead is one of opportunity that is matched with responsibility. Remember, we have a stable macroeconomic base. Inflation is easing, the currency is strong regardless, and reserves are healthy as we speak. Also remember that the banking sector is robust with the capacity to expand lending and deepen financial inclusion. And thirdly, remember that the regulatory agenda, as I've outlined, is forward-leaning. It is aligning Ghana with the highest international standards. Your tasks as leaders of the sector is to translate stability into growth, to channel more credit into productive enterprises, to support SMEs, to finance critical infrastructure, and leverage digital innovations to reach undeserved markets. Clearly, this will require sound risk governance. It will require unwavering compliance, and it will require a willingness to rethink your business models, considering changing customer needs, the tech disruption that is ongoing, as well as climate and sustainability challenges and other issues. At the Bank of Ghana, we are committed to engaging with you constructively, and we've been doing that so far through your association. We'll emphasize a clear regulatory guidance at each instance, and we will be supporting innovations that enhance the resilience as well as the competitiveness of Ghana's financial system. So in closing, let us approach today's discussions, which are meant to be frank as usual, not as a checklist of compliance items, but as a strategic conversation about the future of banking in Ghana. The monetary policy decisions give us an opening to shift from defense to growth, from consolidation to expansion, without losing sight of the lessons learned over the past years. The stability we enjoy today was hard-won over the past 6 months. It is now our joint responsibility to ensure it is not only preserved, but leveraged for sustainable and inclusive prosperity. I look forward to a frank and solutions-oriented engagement this morning, and together we can ensure that Ghana's banking sector remains a pillar of confidence, a pillar of innovation, and a pillar of economic transformation. I thank you for your attention.